We have a slightly quieter week coming up, at least according to the scheduled news releases, but it should be no less informative for that. From a top-down perspective, the most interesting data is likely to come from America, where economists are starting to fret that US output is losing momentum again. As local lockdowns come into force, the virus won't go away, government support programs come to an end, and Congress can't agree upon a further stimulus program. Retail sales, durable goods orders, local Fed purchasing managers indices and other indicators have started to slow down, although it must be said that housing sales are still going gangbusters, so the news is by no means uniform. Anyway, the latest chance to test America's economic temperature comes with two data sets, and they are the Job Opening and Labour Turnover Survey, or JOLTS, on Tuesday the 6th of October, and the latest weekly unemployment claims data on Thursday the 8th. The JOLT survey helps to measure job vacancies. As you might expect, the more vacancies an economy is creating, the stronger it's likely to be, and vice versa. The number of vacancies stood at 389,000 in January, but that had crashed to 266,000 by May. The last reading for July showed some improvement at 337,000, so it'll be interesting to see what August brought. 2 days later, we'll get the weekly unemployment claims figure. This peaked at 6.9 million in late March as the pandemic hit America, but it's thankfully come down a long way since then. However, the number of new claims seems to have stopped improving, and the September 17th figure of 870,000 is your benchmark here. On the home front, we have a select number of companies due to update their shareholders on trading via an update or first half or full year results. Names which may be worthy of further research include the following, although please note these dates are still subject to change. Iron ore miner Ferrexpo on Tuesday the 6th of October, Virtue Motors on the 7th, tobacco giant Imperial Brands and recruitment specialist Robert Walters on the 8th, and to finish, FTSE 100 bookmaker GVC on Friday the 9th of October. But the company most likely to cause a fuss in the week ahead is Tesco. The grocer is scheduled to release first half results on Wednesday the 7th of October, and this will be the investors' and analysts' first real chance to hear from new Chief Executive Officer Ken Murphy. Dave Lewis, having delayed his departure to help see Tesco through the pandemic, stepped down on the 30th of September after 6 years at the helm. Given how heavily the UK has relied on its single biggest grocer this year, thanks to the pandemic, Tesco's market share is almost 27% according to consultants Kansar World Panel, you might be surprised to learn the shares are actually down by around 10% over the past year. This does, however, follow a similar pattern to that at rivals Morrisons and Sainsbury's for what I would guess are broadly similar reasons. First, Tesco has lost market share over the past year, albeit only 0.1 of a percentage point in what remains a fiercely competitive market. Second, the market might be able to get fiercer still, as Marks & Spencer teams up with Ocado, Morrisons cements its relationships with Amazon, Aldi starts to offer click and collect and delivery services, and Amazon prepares to offer delivery to its prime service customers. Finally, the pandemic means that volumes and sales have gone up, but so have costs, so the overall benefit to profits may turn out to be pretty limited, for all that the nation is grateful to Tesco and its staff for their help during these trying times. Tesco's first quarter update hinted at this final point in June. Group sales were up 7.9% year-on-year on a like-for-like basis, with the UK up 8.7%, where online sales were up 49%. Business at wholesale arm Booker was a little bit more subdued, with like-for-like sales up just 0.6%. Strong retail demand was more than offset by a one-third slump in sales to the catering trade. Still, revenues were strong, but outgoing boss Dave Lewis noted how the company had helped to feed and water the nation and, I quote, double its online capacity, but at a cost, saying, "The costs of doing this have been significant and only partly offset by business rates relief and increased volume." So when it comes to the first half results, analysts will look to three key sets of figures. The first is like-for-like sales growth in the second quarter and the first half overall. It seems logical to assume that the rate of growth eased a bit for the June to August period as people began to venture out again, and were actively encouraged to do so by the government's Eat Out to Help Out scheme, for example. The second figure is the headline pre-tax profit number. For the full year, analysts are looking for £1.4 billion on a stated basis, marginally up from last year's £1.3 billion. Note, however, that last year's figure was weighed down by £487 million of supposedly one-off or exceptional items, which may or may not recur this time. By way of a benchmark, stated pre-tax profit in the first half of last year was £494 million. The third headline figure is the dividend. Tesco slowly rebuilt its payment up from 2016 and 2017 when it offered nothing at all, and in the full year to February 2020, the firm paid out 9.15 a share. Alongside the full year results, management noted it expected a first half payment that was 35% of last year's full year total. That implies 3.2 a share, up from 2.65p at the first half stage last year. However, management's also targeting a 50% payout ratio for all of this year, and with extra COVID costs and a higher tax charge, analysts are interpreting this to mean a drop in the full year dividend to 8.1 a share. We shall see. Also look out for comments on the planned special cash distribution once the Thai and Malaysian business disposal goes through. £5 billion is the planned cash return, and that equates to 51 per share. Asia, by the way, will be treated as a discontinued segment in these results. Above and beyond that, watch out for any comments from new boss Mr. Murphy on the goal to generate synergies worth £210 million in total from Booker by January 2021, as well as any progress in the goal to reduce group net debt. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.